Thank you so much for joining me. In today's video, I'm going to be talking about how less than 25% of people know how much they need for their retirement. My aim in this video is to give you some confidence and clarity around the level of income that you want to target. The target levels of income that we'll be looking at will be based around the research from the PLSA, and these are broadly broken down into minimum, moderate, and comfortable standards of living. Also, please watch until the end of the video, and I'll give you a great example of a little boy called Matty S, who has been able to save for a relatively short period of his working life, hasn't saved for the majority of it, and yet still has a decent sized pension pot at the point he wants to take his income from it. Now, more than ever, it's really important that we engage with our retirement outcomes. So, get yourself a nice little coffee and let's get into this. For those of you that don't know me, my name's Ed Bailey and I'm a chartered financial planner with over 10 years experience in financial services. As mentioned, I will be using the income levels as set by the PLSA as far as meeting those various standards of living. So what we'll do is we'll look at those in a bit more detail. So as on the screen, you can see that these are broken down into 3 levels of income. Clearly, we all have different motivations and interests in our lives, and therefore how we spend our money will vary. But ultimately, there are going to be very common themes amongst everyone. These are the retirement living standards. So let's break these down in a bit more detail. For a single person, to meet the minimum standard of living is £10,200 a year. Now, bear in mind that the state pension itself is approximately £9,100 at the moment, so broadly speaking, most people are actually not too far away from that. The minimum standard of living for a couple is £15,700. If you've got a couple, both of them with full state pensions, then quite clearly they're going to be over that already. So a minimum standard of living really covers all of your needs, with some left over for a bit of fun and some social occasions. As stated on there, it's basically saying that we can holiday in the UK, which clearly right now is pretty much what most people are doing, eat out about once a month, and do some affordable leisure activities about twice a week. Interestingly, the research shows that around 3/4 of employees will be able to meet the minimum standards. For a moderate standard of living, for a single, that's £20,200 a year, so effectively that's almost having another state pension on top of that. Couple is £29,100. Again, this is really broken down to having a bit more financial security and more flexibility. This is actually having one foreign holiday a year, eating out a few times a month, and having more opportunity to do the things that you want to do. According to the research, around half of employees are expected to meet between the minimum and moderate standards of living. The comfortable standard of living, $33,000 for a single, $47,500 for a couple. This allows you to be a bit more spontaneous with your money. You could have a subscription to a streaming service, regular beauty treatments, and a couple of foreign holidays a year. In this research, PLSA thinks about 1 in 6 employees will be able to meet the comfortable standard of living based on the contributions that are going into their pension plans. As we now have a target level of income that we want to hit, I'm now going to use the Cashflow modeling tool to really build that out so we can see really how much we need to contribute to get to a certain level of retirement savings to then be able to meet one of these target levels of income. Obviously, I'm not going to be able to run every single scenario because it's going to vary enormously. In this example, I want to use a couple called Mr and Mrs Pickles. They're both exactly the same age to keep things nice and simple. They're both taking their state pension from age 67. They're not deferring it at all. So they're getting £175 per week each, so approximately £9,100 per year. Their state pensions are going up by 2.5% a year, which is what we've built in here, which is effectively part of the triple lock. So that's the minimum level of increases that the state pension will have. We can now look at their income levels. So we've got 2 lots of £9,100 per year being paid to them. So they're wanting to get to the moderate standard of living as far as the PLSA research is concerned, which is £30,000 a year. So obviously we've got a gap between the 2 lots of 9,100, the 2 lots of state pension, and we've got this gap here. So what they're going to fill it with, 2 personal pension plans that they've been building up over their working lives. So they're going to take these out via drawdown. So they're going to take out £5,900 per per year. So let's have a look at how they built up those pension pots over the years. They've been building these up from age 22 to age 67. So their working lives, they've been paying into personal pension plans. They've been paying in £140 per month, and this is increasing at 2.5% per year as well. So again, in line with the inflation rate that we've set up on our cash flow model at 2.5% per year. So not a ridiculous amount of money that's being paid in each month. So let's have a look at what this actually looks like as far as their savings over time. So what we end up with is a nice looking, what my daughter would call a shark fin here. It's that gradual accumulation of that money over time. So you've got the two factors going on here really. You've got the contributions going in and you've got a growth rate. The growth rate that we built into this is 5% per year. So this is increasing at approximately 5% per year. But we do need to take into account the inflation rate, which is 2.5% a year. So effectively it's growing by 2.5% per year in real terms. So the accumulated pot they end up with at this point in time is £140,000. So if they're taking their income from that £140,000, that would approximately work out about 4% per year that they're taking out of their pension plans. We've built in a 2.5% inflation rate, so you'll see that this is actually going to go backwards steadily over time up until around age 99 that we built this cash flow model until. The reason it's going backwards is that we've got a 5% growth rate, but they're taking out 4%, but we've also got 2.5% is our inflation rate. So they have a number of options here. Either they can be comfortable with this scenario, or they can look to achieve a greater rate of growth on their pension fund, or they can look to take out less income, so they won't meet that moderate standard of living, the £30,000 a year. But that's the nice thing with drawdown, is that they can adjust how much they take out of their drawdown policy. Now what's interesting here is if we adjust this inflation rate. So this really gives you a good example of what nominal versus real rates of return look like. So in here we've got our 2.5% inflation rate, and you'll see if I adjust this down to 0, so we have no inflation at all, the impact that this has on the assets over time. The growth rate is obviously then a real rate of 5%. So these are nominal values based on 0% inflation rates. Now if we take this to the other extreme and we juice the inflation rate right up to a massive 10% per year, impact on their assets is actually pretty massive, and they end up in severe amount of deficit as far as the real value of that money has been completely eroded. I now want to show you an example of a little boy called Matty S, who has been contributing to pension but for a relatively short period of time, and then he doesn't contribute for the rest of his working life. So let's look at what this looks like on the cash flow plan. So in this situation, little Matty S is contributing to his pension plan from age 18. So he's not going to university, he comes straight out. He's earning a pretty good salary, so let's say he's earning, what, 18, 19, £20,000 a year, and he's getting that from age 18 to age 27. He's been really sensible, and he's paying approximately £200 per month, so that would work out about 10%, 11% of his salary into a pension plan. But he's only doing this until age 27. We have got it increasing at 2.5% a year, so for that period of time it is going up. What this looks like as far as on our little cash flow plan is that, interestingly, obviously it does increase significantly for the first few years, and then it does sort of shallow out a bit. But what we've built in here is a 7.7% growth rate. We have got an inflation rate in here of 2.5%, which gives a real return of 5.2% per year. So in effect, this money is going up by 5.2% a year. But the interesting thing is, it's only from age 28 all the way up until age 67, he's not even contributing into his pension plan. This is the wonderful impact of compounding growth. Now, 7.7% growth per year might sound high, but in reality, that is what the FTSE 100 has done since 1985 on an annualized basis. So it's not a ridiculous amount of growth, so it is achievable. Obviously, that would be at the higher risk end, effectively 100% equity exposure. But you could argue that wouldn't be unreasonable for a younger person. Obviously, what we need to bear in mind is that as he approaches retirement, that any kind of impact on this fund as far as some sort of stock market shock could be pretty detrimental to him, adjusted for inflation. So the real rate of return is about 5%. The nominal return, if we were to look at that and take inflation rate down to 0, is pretty massive. In nominal terms of about £620,000, but adjusted for inflation, it would be £213,000. So not too bad, given he hasn't contributed for the most of his working life, bearing in mind he would also have a state pension on top of that as well. We can now look at what that would look like if he was to do that contribution of £200 a month for his entire working life. So in this scenario, he's contributing £200 a month for his whole working life by age 67, or potentially he could retire a bit earlier, maybe at age 55. He's got £250,000 there. At age 67, pretty significant at £438,000. And you can see how steep that gets as far as you go further and further out if he's not taking any money out and he's still growing it at the same annualized rate. I also just very quickly want to show you what a significant market event would look like on this kind of pension plan. So in this scenario, I built in the 08-09 financial crisis, the banking crisis that we had. And this has a pretty massive impact. So it doesn't look that significant, but here we'll see a drop of 35% in the value of Matty S's pension fund, which does have a big hit, which he needs to make up that shortfall. And it takes time for that money to grow back to where it was at that point in time. So it's not until around age 50 that he's pretty much back to where he was when he was at age around 41, 42. So age 67, he has a significantly lower fund of 263,000 versus when he had no market event at all and the value was £438,000. So just something to bear in mind, that when we're talking about these things, we're looking at a very linear pattern here, and we're not building in that variability and volatility that you would see in reality. So we do have to bear in mind that values can go up as well as down. If you did need some more information on how you can take your retirement income, you can see that in this video right here. I look at the various ways that you can actually draw an income from your retirement savings. If you did find this useful, then please comment and like below. Also subscribe so that you don't miss out on any upcoming content that I do release. Thanks so much. Bye-bye.